Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today, we're going to talk about mainly our consumer staples sector, maybe get an update on healthcare. Joining me today is our portfolio manager responsible for these two sectors, Brian Durno. Hey, Brian, welcome.
Hey, Mike. Thanks for having me.
So before we dive into consumer staples, maybe just an update on the healthcare front. You wanted to give us an update there in terms of our previous conversation?
Yeah, sure. We talked, I think, in our last chat at some length about Amgen's one of their big drugs that they have under development that's in the diet drugs space. So maybe that would be worth mentioning that if you remember, we talked a little bit about the valuation techniques that we use to try to deal with a company that has this potentially blockbuster drug in their books. And maybe I'll just mention that this quarter there was let's say a positive development on the progress of that drug. That, without going into the specific details, I can just tell you that we've increased the probability of success in our valuation model. So it was meaningful enough information for us to feel more positive about the future for that drug. Still a long ways from home.
Still a long ways? Okay.
Yeah.
All right.
Yeah. But heading the right way.
All right. Okay. Good to hear. Good to hear. Okay. Let's talk about consumer staples. Maybe you want to just remind the listeners what's in consumer staples?
Certainly. Yes. This would be mostly the companies that sell products that would be non-discretionary in nature. So you can think of things like in the grocery store that, not food in that case, but things like, bounce sheets and soap and things that you need, pretty much every shopping trip.
So talk to me about how the sector did from a business perspective.
Yeah, sure. I'll use mostly U.S. data because that is a very, very deep market for these kinds of companies. And most of the companies have reported, so I've got some good data on the group as a whole, and then I'll talk more specifically about our companies. But the group as a whole, the revenue came in around 2.4% compared to last year, so that was growth. Which is great. And the earnings growth came in around 5.5%. So that was pretty good. The whole S&P as a group of all the industries came in around 6% growth. So they were kind of in line with the broader market. So you'd have to say it was a reasonably good quarter. There was a few more negative surprises from the group. So you're starting to see some, let's say, differentiation between the business performance in the group. It's not one aggregate whole that all perform exactly the same. Yeah. So it is very much useful to look at the granular, individual company numbers to see what's going on under the hood.
So speaking of individual companies, then let's talk about our businesses. How did they perform?
Yeah, they performed, let's say, better than the group. So if we looked at the revenue of the ones that have reported, we have a couple of European companies that just give us sort of high level data, not deep dive granular data like the US and Canadian companies do every quarter. So there's this data isn't perfect comps, but mostly it is very, very comparable. So I would say, if you look at the group of companies that we have invested in, the growth rate on the revenue side was about 3.5%. So you remember that compares to 2.4. So better than, a little bit better growth rate on the top line. The earnings growth rate, I had mentioned 5.5% for the group. Well, our companies came in around 13% on average.
Wow. Excellent.
Yeah. So better than expected. Actually, it beat earnings by a pretty good margin, with one particular company that we might talk about in a minute here, that did substantially better than most market analysts would have expected.
So let's dive into it. What company are you referencing?
That was Walmart. Yeah.
Okay.
Yeah, that's, one of the big names. Obviously, everyone will have heard of that one. But it's funny, if I look back, because we do have this sort of by nature hold in our process and our philosophy, and we definitely are attracted to high quality businesses, especially the ones that dominate in their space. And Walmart would be one of those names. And if I think back to around 2022 or so, that market was not a friendly market in 2022 generally, but Walmart specifically had 2 back-to-back inventory warnings, which is very unusual from a very well-managed company like them. And the market just really beat the tar out of them after those 2 back-to-back, warnings. You're talking minus 25, minus 30% in a very short period of time, which is unusual for a big company like that.
Right.
But so, you might be tempted, if you were very short-term oriented, to be very, very worried about something like that and maybe even react to something like that. And so we dug in, and of course we're never happy when management underestimates and makes mistakes with their inventory, especially in retail where you end up having to lower your...
Just so I understand, these were shortages of inventory or excess inventory? Too much. Okay.
Too much. Yeah. Which threatens the, the price. And if you've got too much inventory, sometimes you have to lower the price to clear the shelves.
Yeah.
But in retail, these kinds of things do happen. And they happen to the best in the business, which Walmart proved. And of course the market never likes those kinds of news items. But if you maintain this sort of long-term focus that we do, we're certainly not happy when that happens, but we looked at the valuation, we looked at the stability of the company and all the lovely things that we like about Walmart, and obviously just stayed invested. And in some cases, if we had the opportunity, we could add to it. And that the market, minus 30 during that period, minus 27 or so for Walmart stock. And since then is up like about 80% from that period.
Okay.
So it's just one of those, another lesson. We see this all the time with granular, detailed company analysis. Markets can overreact in the short term, and so when we put our thinking caps on to see if the thesis has changed or if it's just a temporary setback, we don't always get that right, but that is very, very useful to analyze. And in that case with Walmart, we just felt like it was just some bad luck.
Right.
And it didn't threaten the thesis, and then we're certainly glad that we held on to Walmart. And their growth rate in earnings this quarter was 22%.
Oh, excellent. Okay.
So these things kind of move in cycles.
Any other standouts from our core pick perspective?
Yeah, what's funny is we have, I guess we can look at the group as a whole. I guess there's a couple of things happening. We have a couple of positions that we would say are executing extremely well, and the market is rewarding them with, let's say, premium valuation multiples. And so that's something you always have to be very careful about, how far the market stretches.
Right.
Because the good news never lasts forever, sadly. So we pay very close attention to valuation multiples that start to stretch. So we have a couple in that category where, they're not out of line. They're just, let's say, at the higher end of their range. So to deal with that, we have, a handful of other companies that have experienced, let's say, some more difficult or challenging quarters. And so their multiples are much lower, even lower than the group. If the group is trading around 20 times earnings, we have a name or two that are trading around 16 or 17. And so usually that happens because there's something fundamental causing it in the short term. And so we kind of have, if you took our group, our selection of companies in this space, our average multiple is exactly in line with the whole group. So in other words, it's about average. Right. But underneath the hood, what you'll find is you have this sort of barbell situation where you've got a couple of higher valued premium companies that are, let's say, deserving so far in terms of their fundamental performance. And we have a couple who are experiencing more challenges that are available at much cheaper prices. So, when you just look at the average, it looks like you're just average, but underneath the hood, you've got a couple of different things. And ultimately, it's not a terrible way to diversify your portfolio.
Right. Okay. So looking forward, Brian, how does the sector, any thoughts on any headwinds or tailwinds that you guys are watching out for?
Sure. Well, we certainly are paying close attention to these fundamentals. One of the things that does happen, with inflation at the margin, when we look at inflation rates of change, which is what all of us market participants are very focused on, you sometimes forget that the average prices that households are facing are, 15, 20% higher. So that is starting to show up in some of the volume that people, in some of the choices that they're making. One of the reasons Walmart did so well this quarter was trading down, people trading down to the value, more, price sensitive shoppers. And even at the higher income levels, we're seeing Walmart growing their market share from the higher income category, which is interesting. So we are watching that data pretty closely. And when you play it all out, this group is generally pretty defensive. Okay. And when you look back historically over the last, say, 20, 30 years, this sector performs generally really well in periods of weakness or recession.
Right.
So it's one of those, like, you must have some.
Yeah, yes. Everyone needs soap, right?
you must have some of these. So the valuation, of course, this is no secret. And so most market participants would, this wouldn't be news to them. So we have to watch carefully the multiples and the valuations in this area. But that's one thing I might mention, just maybe in closing on this group, is the group might seem at first expensive at 20 times earnings. But that's actually in line with the market multiple on average.
Okay.
And when you compare it to the market on average, you would find it's actually in the lower end of its historical range compared to the average. So relatively speaking, we would argue it's cheap. But then you have to hedge that comment with, well, compared to each individual stock, you need to look at where it is in its range. But so we're not quite as, let's say, afraid as some people might be by the high multiple when the overall market is also at the higher end of the range.
Right. Okay. Brian, thanks for this.
Thanks for having me, Mike.
Folks, as always, if you have any questions, don't hesitate to reach out to your accounting firm financial advisor, your TriCert Investment Counsel portfolio manager, and don't hesitate to reach out to myself. Take care.